Welcome to Market Brief After Hours. We have a lot of ground to cover today. Global markets started the week on a remarkably cautious footing. We are seeing rising oil prices, renewed geopolitical tensions, and some significant weakness in technology stocks. Yet, despite all of that, there are pockets of resilience. Let's start with the big picture in the US. How did the major indices shake out today?
It was a very mixed bag, heavily influenced by a rotation out of growth and into defensive sectors. The Dow Jones Industrial Average actually managed to edge higher. It added exactly 50 points, which translates to a 0.11% gain. That divergence was largely thanks to strength in financials and utilities, which helped offset the bleeding we saw in other sectors. However, it is still hovering near correction territory after the sustained losses we've seen recently.
And the rest of the market didn't fare quite as well, did it?
Not at all. The S&P 500 slipped closer to correction territory, declining 0.39%. That extends its total pullback to 9.3% from its 52-week intraday high. That drop was primarily driven by a sharp sell-off in technology stocks, which fell more than 1% as a group. Investors are clearly rotating away from growth and seeking shelter in defensives as energy prices continue to bite. Naturally, that tech weakness hit the Nasdaq composite the hardest. The Nasdaq dropped 0.73%, underperforming the other major indices. The heavy selling there really reflects how sensitive high-growth equities are to rising input costs right now.
That rotation into defensive names isn't just a U.S. phenomenon, is it? Looking across the Atlantic, European markets actually closed higher today.
They did, and it is a fascinating dynamic. Investors in Europe piled into defensive sectors despite the overarching geopolitical tensions. The pan-European STOXX 600 gained 0.8%. Looking at individual countries, the UK's FTSE 100 climbed 1.43%. France's CAC 40 rose 0.79%, and Italy's FTSE MIB advanced 1.02%. Over in Germany, the DAX added around 1.2%, which finally snapped its recent losing streak. We also saw Switzerland's SMI increase by 0.78%.
On the surface, that looks like a strong day for Europe, but the underlying economic signals tell a different story.
Exactly. Beneath that equity rally, the economic data is actually weakening notably. The Eurozone Economic Sentiment Indicator fell to 96.6 from 98.2, which completely missed expectations. Consumer confidence also took a dive, dropping sharply to negative 16.3 as inflation expectations surged. In Germany, inflation accelerated to 2.8% year-on-year. Spain saw retail sales rise 2.2%, but that still undershot forecasts, and Italy's producer prices declined 2.7%. It points to highly uneven growth across the region. Even in the UK, where consumer credit rose to £1.9 billion, beating expectations, it did very little to mask the broader concerns about slowing economic momentum.
Moving over to Asia, the picture was much darker. There wasn't any defensive rotation to save the indices there.
Asia-Pacific markets faced a broad and sharp decline. Deteriorating risk appetite, intensifying conflict, and surging energy prices hit the region hard. South Korea's Kospi fell 2.97%, and that was actually a recovery from earlier in the session when it was down more than 5%. The Kosdaq also declined around 3%. In Japan, the Nikkei 225 lost 2.79%, and the Topix dropped 2.94%. That was fueled by Bank of Japan commentary hinting at a potential acceleration in policy tightening.
And the weakness extended into Australia and China as well.
Yes, Australia's ASX 200 eased 0.65%, and New Zealand's NZX 50 fell 1.4% on broad-based sector weakness. Hong Kong's Hang Seng declined over 1%, and China's CSI 300 slipped 0.24% to close at 4,492. I also have to highlight the Indian markets. They came under intense pressure. The Sensex fell 2.22%, and the Nifty 50 dropped 2.14%. Both of those indices are now at their lowest levels in nearly a year, marking their steepest monthly declines since 2020.
We are going to take a brief pause right here. When we come back, we will dive into the massive moves in the energy sector, break down the latest foreign exchange technicals, and look at today's biggest individual market movers. Stay with us. Welcome back. Before the break, we touched on the impact of surging energy prices. Let's look at the actual numbers, because the moves in the oil market right now are staggering.
They truly are.
US crude settled up 3.25% today at $102.88. That is its highest close since July 2022. Brent crude is performing even more aggressively, rising to $112.78. To put that in perspective, Brent is currently on track for a record monthly gain of around 55%. This sharp rally is entirely reflective of the ongoing supply concerns linked to the Middle East conflict. Sustained disruption risks are dominating how the market is pricing these contracts.
Interestingly, while inflation pressures from energy are rising, Treasury yields actually fell today.
That was a crucial development. The 10-year Treasury yield declined more than 9 basis points to 4.344%. The 30-year yield fell to 4.906%, and the 2-year dropped to 3.834%. This downward move followed comments from Fed Chair Jerome Powell, who indicated that inflation expectations remain anchored. That messaging prompted the markets to scale back their expectations of further aggressive rate tightening in the near term.
Let's pivot to the foreign exchange and commodities markets. There are some very clear technical setups forming, especially when we look at the moving averages. Let's start with the euro against the dollar.
The Euro-USD pair is seeing bearish momentum really build up. It closed at 1.1458, down 0.44% for the session, after trading in a range between 1.1521 and 1.1443. Selling pressure dominated all day, pushing the pair to fresh cycle lows. When we look at the simple moving averages, or SMAs, the technical damage is clear. The price is firmly below the 50-day SMA at 1.1719, the 100-day SMA at 1.1687, and the 200-day SMA at 1.1676. All of those averages are sloping lower, reinforcing a strong bearish structure. We've seen a clear sequence of lower highs and lower lows since the pair peaked near 1.2090 in February. Immediate resistance is now at 1.1521, and support is at 1.1443. If it breaks below that, we are looking at the 1.1400 psychological level.
The British pound is painting a very similar picture against the dollar, isn't it?
It is. GBP USD slid further as its downtrend accelerated. It closed at 1.3183, down 0.59%, ending the session right at its lows, which signals very strong bearish conviction. The pair traded between 1.3282 and 1.3183. Just like the euro, the pound is trading well below its key moving averages. The 50-day SMA is up at 1.3496, the 100-day is at 1.3412, and the 200-day is at 1.3430. All of them are aligned to the downside, acting as overhead resistance. It's been a consistent pattern of lower highs and lower lows since the February peak near 1.3850. Support sits at 1.3183, and if selling persists, the next targets are 1.3150 and 1.3100.
What about the dollar against the Japanese yen? That trend seems to be holding up differently.
Yes, USD-JPY is maintaining its broader bullish outlook, despite a slight pullback today. It closed at 159.70, down 0.34%, after trading between 160.46 and 159.32. Sellers capped gains near recent highs, but the price remains firmly above its moving averages. The 50-day SMA is at 156.83, the 100-day is at 156.43, and the 200-day is way down at 152.44. All of these continue to trend higher. Resistance is at 160.46, while support is seen at 159.32. As long as it holds above those support levels, the uptrend remains completely intact.
And looking at the precious metals, gold and silver saw some volatile price action today.
Gold rebounded modestly but is still struggling with key resistance. It closed at $4,515, up 0.50%, trading between $4,580 and $4,418. It's showing a tentative recovery after a sharp correction, but the price is still trapped below the 50-day SMA at $4,951 and the 100-day SMA at $4,610. Both are acting as heavy overhead resistance. It is, however, finding underlying support from the 200-day SMA at $4,100. Right now, it looks like a phase of consolidation.
Silver seemed to show a slightly stronger signal today.
It did. Silver stabilized after a very volatile session, forming a strong recovery signal from its intraday lows as buyers stepped in aggressively. It closed at $70.16, up 0.60%, trading between $71.74 and $67.71.
Technically, it is also below its 50-day SMA at $84.32 and its 100-day SMA at $73.88, but it is holding nicely above the 200-day SMA at $57.68, which supports its broader bullish structure. A break above that $73.88 resistance would really strengthen the prospects for a full recovery.
Let's wrap up with the individual market movers. There were some massive double-digit swings in individual equities today. Start us off with Boston Scientific.
Boston Scientific took a major hit, tumbling more than 9%. The medical device manufacturer was downgraded by analysts at Raymond James, who cited weakening trends in the company's primary growth sectors. On the flip side, United Therapeutics had a phenomenal day. Shares surged nearly 13% to hit a new 52-week high. The catalyst there was the company reporting highly successful Phase 3 clinical trial results for its lung disease treatment, Tyvaso.
But the biotech space wasn't all positive today. Viridian Therapeutics had a brutal session.
Absolutely brutal. Viridian plummeted more than 32%. They released late-stage trial data for their thyroid eye disease therapy, and the efficacy results simply failed to meet investor expectations. In the food distribution space, Cisco also took a heavy beating, declining over 15%. They announced a massive $29.1 billion deal to acquire Jetro Restaurant Depot. While acquisitions can be positive, the market's immediately focused on the massive debt burden Cisco will have to take on to fund the deal, and investors hit the sell button.
Finally, we have to mention Micron. The pain continues for the chipmaker.
It really does. Micron shares extended their post-earnings slump with another double-digit loss today, dropping 10%. If you zoom out, the memory chipmaker has now seen its stock decline by a total of 30% since it reported earnings back in mid-March.
It certainly paints a picture of a market under immense pressure. Between the elevated energy prices, the persistent geopolitical uncertainty, and the developments around the Strait of Hormuz, the fragile tone is completely justified. The CBOE Volatility Index, moving above 30, really tells the story of how much caution is out there right now as participants hedge against further downside. That is all the time we have for today's breakdown. If you find this useful, please follow Market Brief After Hours.